All right, let's get right into it. The man who could be the next chair of the Federal Reserve, he isn't just a potential policy change. He is the market event. We're talking about Kevin Warsh, and his nomination is setting the stage for one of the most predictable telegraph trading events we've seen in years. But here's the thing, it's not for the reasons you might think. The real story isn't just his economic doctrine. It's the fact that he's about 4 times wealthier than Jerome Powell, and before he can even sit in the chair, federal law might force him to sell, well, pretty much everything.
So let's just cut straight to the chase. The part of this story that makes it completely different from any Fed transition we've ever seen before. And it all comes down to the absolutely unprecedented scale of personal wealth at the very top of the world's most powerful central bank.
And this slide right here really puts it all into perspective. I mean, look at this. The current Fed chair, Jerome Powell, is, by any measure, an incredibly wealthy person. We're talking a net worth of around $50 million. But Kevin Warsh, he is playing in a completely different league. His fortune is at least 4 times that size. This creates a situation the Fed has literally never had to deal with before. And just to put a finer point on it, when you go through the financial disclosures, his total assets are somewhere in the ballpark of $131 to $209 million. So yeah, this would officially make him the wealthiest Federal Reserve chair in U.S. history. And not by a little, by a mile. So you might be asking, where does this kind of money come from? Well, it's really a combination of a classic Wall Street story, a high-flying career at Morgan Stanley, being a key advisor to the investing legend Stanley Druckenmiller, which was then massively amplified by his marriage to Jane Lauder. And yes, that's Lauder as in Estée Lauder, the cosmetics dynasty. She's an heiress whose personal net worth is in the billions. And this brings us right to the absolute heart of the matter. This isn't just about a rich guy taking a government job. No. Federal ethics laws create this fascinating problem. To avoid any possible conflict of interest, Warsh would almost certainly be forced into a massive, and I mean massive, rapid-fire sale of his personal assets. This isn't a choice he gets to make, it's a legal requirement. And that requirement is what sets up a truly unique market scenario. So how would this actually work? Well, this leads us to what we're calling the Great Divestment. This is where we really get into the mechanics of this forced liquidation, and it uncovers a really crucial concept. It's a thing that separates how everyday investors see the market versus how the pros really operate. You see, it all comes down to this legal rule called ethics divestiture. It's totally non-negotiable when you take a top government job like this. The idea is simple. You cannot be in a position where you're making policy decisions that could, even by accident, make you richer. And for a guy like Warsh, that means having to sell a portfolio that is huge, complex, and in some spots, really, really hard to sell quickly. And just look at what's on the chopping block here. We are not talking about a few shares of an S&P 500 fund. This list includes 2 private equity funds, each worth over $50 million, stock from his board seats at huge companies like UPS, and yeah, even indirect stakes in cryptocurrencies. These are not the kind of assets you can just unload with a click of a mouse without making some serious waves. I want you to imagine a giant whale being legally forced to jump out of a tiny backyard swimming pool. What's going to happen? It's going to cause a massive, totally predictable wave, right? Well, in the market, this is what the big institutional players call telegraphed flow. It's a huge chunk of selling that everyone knows is coming from a seller who doesn't really care about the price. They just legally have to get out. In this quote right here, it just sums up the entire game perfectly. While most of us, the retail crowd, are going to be reacting to the headlines about confirmation hearings, the quote-unquote smart money is focused entirely on this divestment. They see a massive, price-insensitive seller who is legally required to dump specific assets by a certain time. And let me tell you, that is an opportunity that just doesn't come around very often. So you've got this market whale who's being forced into this giant personal sale. Now, this isn't just some interesting side story. It's actually fundamental to understanding the kind of policymaker he would be. This background shapes his whole worldview. So with that in mind, what kind of doctrine, what kind of philosophy would a Chairman Warsh actually bring to the Fed? You can really break his philosophy down into 3 core pillars, and each one is a pretty dramatic break from the Powell era. First, he wants to aggressively shrink the Fed's massive footprint. Second, he wants to engineer a very specific twist in the bond market. And third, he wants to use the story of an AI boom to justify cutting interest rates. Okay, so that first pillar, and probably the most radical one, is active QT. For years, the Fed's quantitative tightening has been super passive. They basically just let their old bonds expire and don't replace them. It's lazy.
Warsh wants to become an active seller, literally putting trillions of dollars of assets back onto the open market. That would be a massive change, turning the Fed from the market's biggest buyer into a big seller. This chart really gives you a sense of the scale we're talking about. At its peak, the Fed's balance sheet was a mind-boggling $9 trillion. It's come down to about $6.8 trillion, but Warsh wants to hit the accelerator on that decline, and hard. Now, historically, anytime the Fed switches from being the biggest buyer in the room to a major seller, it sends shockwaves through the entire financial system.
And we're already seeing the markets start to price this in. His potential nomination is creating what's known as a yield curve twist. So even as the market thinks he might cut short-term interest rates, the long-term rates, the ones that influence mortgages and business loans, have stayed stubbornly high. Why? It's because the market is already demanding extra compensation, a term premium, to hold on to long-term government debt. In other words, investors are bracing for a future where the Fed isn't their guaranteed biggest customer anymore.
Now, this whole radical plan is anything but a done deal. His nomination is just surrounded by controversy. Big policy debates, a ton of political maneuvering, and some really fundamental questions about what his true motivations really are. And one of the biggest puzzles for everyone is this sudden pivot. You see, for most of his career, Warsh was known as a monetary hawk. He was always warning about easy money, always worried about inflation. But now, all of a sudden, he's arguing for rate cuts. His reasoning is this idea that an AI-powered productivity boom is coming that will let the economy roar ahead without causing inflation. But a lot of critics are looking at this convenient change of heart with a lot of skepticism. And the questions just keep piling up. There are really serious concerns about whether he can keep the Fed politically independent, given his well-known ties to Donald Trump. There's the huge gamble on whether this AI productivity boom is even real or just a nice story. And finally, you have to remember, as chair, he only gets one vote. He still has to convince a majority of the board to go along with these radical plans, and that is not a guarantee at all. And if all those policy debates weren't enough, there is a very real, very direct political blockade happening. Republican Senator Tom Tillis has gone on the record saying he will block Warsh's confirmation, period, until a Department of Justice investigation into some renovations at the Fed under Jerome Powell is finished. So this ties Warsh's entire fate to a totally separate issue, creating a huge procedural roadblock in the Senate. And this brings us right back to where we started. Back to the most important takeaway in this whole situation, and that is the huge gap in information and in strategy between two very different types of investors. Look, the most important thing to understand about the Warsh nomination is this. There isn't just one story happening. There are two completely different games being played at the exact same time. And knowing which game you're actually watching, well, that changes everything. Retail investors, that's most people, they trade the noise. They react to the big headlines about the announcement. They get swept up in the political drama of the confirmation hearing. But the institutional players, they're focused on a very quiet, very specific window of time, the period right before the hearing, when that mandatory forced selling has to take place. That is the signal. Think about it. They know which assets have to be sold. They have a pretty good idea of when they have to be sold. And most importantly, they know the seller is motivated by a legal deadline, not by getting the best price. So they can get in front of it. They can position themselves to absorb all that forced selling, maybe at a pretty nice discount, while everyone else is glued to the political theater on TV. And so, at the end of the day, this completely unprecedented situation leaves us with a pretty tough final question. The Federal Reserve is supposed to manage the economy for all Americans. That's its mandate. But when its leader comes from a world of such extreme wealth, and their very appointment triggers a market-moving event of this size, it really forces us to ask whose interests will truly come first.